Insurance can be broadly classified into two types, life insurance and general insurance. Again, the general insurance can be classified into three types, fire insurance, marine insurance, and other insurance. Examples of other insurance are vehicle insurance, health insurance, burglary insurance, cattle insurance, crop insurance, sports insurance, अमर्त्य शिक्षा योजना, राजेश्वरी महिला कल्याण बीमा योजना. This list of other insurance is only for illustration. There are many other insurances like shopkeeper insurance, householder insurance, electronic equipment insurance, professional indemnity insurance. The list is very large one. This is only for illustration purpose. Now we will discuss life insurance. Life insurance is a contract between an insurance policy holder and an insurer, where the insurer promises to pay a designated beneficiary a certain sum of money upon the death of an insured person, often the policyholder, or on expiry of certain period. The policyholder pays premium in lump sum or periodically, that is monthly, quarterly, half yearly, or yearly. The agreement or contract which contains all the terms and conditions of the insurance is put in writing, and such document is called the policy. The person responsible for making premium payments for a policy is the policy owner, while the person whose life is insured is called insured. The owner and insured may or may not be the same person. For example, if Joy buys a policy on his own name, he is both the owner and the insured. But if his wife Lena buys a policy on Joy's life, she is the policy owner and Joy is the insured. The insurance company is called the insurer, and the consideration paid by the policy owner or insured is called premium. In cases where the policy owner is not the insured, the insurance companies restrict the policy purchases to those with an insurable interest in the insured. For life insurance policies, close family members and business partners will usually be found to have an insurable interest. If the principle of insurable interest is not applied in life insurance, the risk that a purchase that a purchaser would murder the insured for insurance proceeds would be great. In at least one case, an insurance company which sold a policy to a purchaser with no insurable interest, who later murdered the insured for the proceeds, was found liable in the court for contributing to the wrongful death of the victim. This is here has been given, it is the judgment which was passed by the court. Importance or benefits of life insurance. Life insurance provides protection to the family at the premature death of an individual. Life insurance is a sort of investment because a certain sum is returnable to the designated beneficiary on the death of life insured or at the expiry of a certain period. Life insurance encourages savings as the premium has to be paid regularly. Common exclusions include claims relating to suicide, fraud, war, riot, and civil commotion. The policy becomes null and void if the insured dies by suicide within a specified time after the purchase of insurance. Usually, 1 or 2 years suicide clause is there in life insurance policy. Now we will understand the main elements of a life insurance contract. These are as under. The life insurance contract must have all the essentials of a valid contract. Certain elements like offer and acceptance, free consent, capacity to enter into a contract, lawful consideration, and lawful object must be present for the contract to be valid. Second is the contract of life insurance is a contract based on utmost good faith. The assured should be honest and truthful in giving information to the insurance company. He must disclose all material facts about his health to the insurer. It is his duty to disclose accurately all material facts known to him, even if the insurer does not ask him. In life insurance, the insured must have insurable interest in the life assured. Without insurable interest, the contract of insurance is void. In the case of life insurance, insurable interest must be present at the time when the insurance is affected or taken. It is not necessary that the assured should have insurable interest at the time of maturity also. Suppose a wife took a life insurance policy on the life of his husband. After 1 year, the couple got divorced, and later on, the husband dies 2 years after divorce. If the ex wife is continuously making payment of the premium even after divorce, she can still collect the death benefit from insurance company even when she no longer has an insurable interest in her ex-husband, unless the divorce settlement does not include any provisions that might change this. The insurable interest must be present at the time of taking of life insurance policy. Some other examples of insurable interest in the case of life insurance are as under. A person has insurable interest in his or her own life and also in the life of his or her spouse. A creditor has an insurable interest in the life of his debtor, and an employer has an insurable interest in the lives of his employees. Fire and marine insurance contracts are contracts of indemnity. That is, they provide compensation to the insured for loss or damage sustained. In the case of vehicle insurance, if the car is damaged, the insurance company will get the vehicle repaired or replaced. But in the case of life insurance, is it possible for the insurance company to bring the person back to life? Not at all. Principle of indemnity applies where the quantum of loss can be fairly and accurately measured. There is no question of indemnification in the question of life insurance because the loss resulting from the death cannot be estimated in terms of money. Life insurance contract is not a contract of indemnity because the value of human life cannot be measured in terms of money. That is why the amount payable in life insurance on the happening of the event is fixed at the time of entering into the contract. Now we will understand the type of life insurance policies. When the proposal form is filled by the insured or the proposer and the insurance company accepts the same and the premium and a policy is issued to the insured. People have different requirements and so they would like a policy to fulfill all their needs. Therefore, to meet the different needs of people, insurers have developed certain different types of insurance policies. Some of the insurance policies are described below. First is whole life policy. A whole life insurance policy provides lifetime coverage until the death of the life assured. In this policy, the premium is payable for a fixed period, say 20 or 30 years, or for the whole life of the assured. The sum assured is paid to the nominee when the life assured dies. Second is endowment life insurance policy. The endowment policy is a life insurance contract which is designed to pay a specified sum after a specific term on its maturity or on death, whichever is earlier. In the case of death of the assured, the sum is payable to the nominee or legal heirs. Otherwise, the sum will be paid to the assured after a fixed period, that is, when he or she attains a particular age. Third is joint life policy. This policy is taken by two or more persons. The premium is paid jointly or by either of them in installments or in lump sum. The assured sum or policy money is payable upon the death of any one person to the other survivor or survivors. Usually, this policy is taken up by the husband and wife jointly or by two partners in a partnership firm, where the amount is payable to the survivor on the death of either of the two. Now, the fourth policy is annuity policy. Under this policy, the premium is paid in installments over a certain period, or single premium may be paid by the assured. When the assured attains a certain age, the assured sum or policy money is payable in monthly, quarterly, half yearly, or annual installments. This type of policy is useful to those who prefer a regular income after a certain age. Now, fifth policy is children's endowment policy. This policy is taken by a person for his or her children to meet the expenses of their education or marriage. The agreement states that when the child attains a particular age, a certain sum will be paid by the insurer. The premium is paid by the person entering into the contract. A child endowment policy plan is unique as it has a clause that if he, that is parent, dies before the maturity of the policy, no premium will be paid. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.